Welcome to our Liechtenstein Financial Services podcast. In the Liechtenstein Financial Services podcast, we will primarily explore the legal, regulatory and tax perspectives of banks, funds, asset managers and other participants in the Liechtenstein Financial Center, a production of PwC Liechtenstein. Today we are discussing the redesign of the financial market law in Liechtenstein. I am Ilario Monti, your host, with 11 years of experience at PwC, specializing in auditing and consulting for banks and other financial services institutions. With this podcast, we aim to provide a concise overview of the current developments. Our podcast today focuses on the opportunities and challenges arising from the redesign of the financial market law in Liechtenstein. Joining us today is Philipp Rosenauer, partner at PwC and an esteemed expert in the legal field. Welcome, Philipp. Philipp, can you tell us a bit about yourself and your connection to Liechtenstein?
Sure, absolutely. Happy to do so. As you already mentioned, my name is Philipp Rosenauer. I'm a partner at PwC. And I'm primarily focused in my work on financial services regulations and how we can support our clients to implement them in a pragmatic and risk-based approach. My connection to Liechtenstein actually is before I joined PwC, I worked for the Financial Market Authority in Liechtenstein and therefore had the other perspective, so to say, on the topic of financial market regulation.
Thank you, Philipp. Let's start with the discussion about the redesign of the financial market law. Could you explain the main goals behind the redesign of financial market law in Liechtenstein and what prompted the government to initiate this reform?
Absolutely. Well, the primary goals of this redesign follow actually a couple of aspects, 3 to 4 aspects. On the one side, primarily idea is to enhance a better financial market supervision to ensure on the one side a better alignment with EU and EEA regulations. That's particularly important because of the international compatibility of the Liechtenstein law. But also it was very important, as we see from the legislative materials, to improve the overall stability and the integrity of the financial system. The government initiated this reform to address the ever-increasing complexity of the financial markets, the technology advancements we are seeing, particularly also in the area of artificial intelligence, and the need for a more specialized and focused regulatory framework. By separating on the one side the prudential supervision from the conduct of business supervision, the aim is also to create a more transparent, efficient, and resilient financial regulatory environment.
That sounds like a significant change. How does the new regulatory structure differ from the current one, especially in terms of the separation between prudential supervision and conduct of business supervision?
Yeah, absolutely. That's a good question. I mean, the new regulatory structure introduces this clear separation between prudential supervision on the one side, which focuses on the financial stability and soundness of banks and security firms, and on the other side, the conduct of business supervision. The conduct of business supervision primarily aims to protect investors and ensure market integrity. Under this new framework, prudential rules for banks will remain in the Banking Act, so in the Bankengesetz, while prudential rules for certain classes of security firms will be housed in a new Securities Firms Act. Conduct of business rules for both banks and security firms will be centralized in a new Securities Services Act. On top of that, regulations for trading infrastructures and markets will be consolidated into a separate Market Act. On the one side, this separation allows for more specialist oversight and also reduces potential conflicts of interest in the oversight.
That sounds like a very detailed and structured approach. What are the key challenges in implementing these changes and how will they impact the market participants, especially banks and securities firms?
Well, it's always difficult, of course, to make predictions in advance, but implementing these challenges involve several aspects, including the need for extensive coordination among the regulatory bodies. It involves also the updating of existing legal frameworks and also ensuring that market participants are adequately prepared for the transition. I believe that for banks and security firms, the impact will have a certain significance as they will need to adapt to a new regulatory requirements and possibly also restructure their compliance processes. However, long-term benefits also include a more transparent and predictable regulatory environment, which then can enhance their operational efficiency and competitiveness.
The reform aims to align Liechtenstein's regulation with the European Union and the European Economic Area law. What specific European regulations are being incorporated and how will this affect the country's financial sector?
Sure. Well, the reform incorporates several key European regulations, including the Capital Requirements Directive, so the CRD 4 and 5, and the Capital Requirements Regulation, CRR2 for banks, as well as MiFID II and MiFIR for security firms. By aligning with these regulations, Liechtenstein ensures that its financial sector remains integrated with the broader European market, which again facilitates the cross-border operations and enhances the attractiveness of Liechtenstein as a financial hub for the European Union. This alignment also helps in maintaining high standards of financial stability and investor protection.
Thank you, Philip, for this detailed information. Could you walk us through the timeline? What milestones should we expect leading up to the final implementation in 2025?
The timeline for the reform is structured to ensure a smooth transition, essentially, and key milestones include, for example, in 2020, so looking backwards, the government's decision to initiate the reform and establish a project group within the Financial Market Authority. From 2021 to 2022, drafting of the new legislation and consultation with the stakeholders. In 2023, there was parliamentary approval of the new laws and initial implementation phase. 2024 started with full-scale implementation and transition support for the market participants. And with January 2025 will be the final implementation and enforcement of the new regulatory framework. Throughout this period, the FMR, of course, is a very supportive market authority, will provide guidance and support to ensure that all the stakeholders are well prepared for the changes.
And how will the new laws help to strengthen the competitiveness of Liechtenstein's financial sectors, and what does this mean for businesses operating within it?
Absolutely. Well, the primary goal, as already mentioned, of the new laws are to design and create a more robust and transparent regulatory environment. These should again help to enhance investor confidence and attract more business to Liechtenstein. Also, the aspect of aligning EU and EEA standards in the financial sector in Liechtenstein will be better positioned to compete on an international level. For businesses operating within the country, this means essentially greater access to the European markets, improved regulatory clarity and certainty, and a more stable financial environment. I believe that ultimately these changes are expected to foster innovation also in, for example, AI development, growth, and also long-term sustainability in the financial sector.
Thank you, Philip, for these insightful explanations. It's clear that the redesign of financial market law in Liechtenstein is a comprehensive and forward-looking initiative. We look forward to seeing how these changes unfold in practice.
Thank you, Lara. It was a pleasure to discuss this topic with you.
From this basis, we will dive into new topics such as legal, regulatory, or other topics in future episodes. So stay tuned for our upcoming episodes. In the meantime, contact us for a personal exchange how Liechtenstein can fit its EU agenda.